Greetings, everybody. This is Jeff Scott, and this is my market review for August 25th, 2019. It is Sunday morning, so before any futures are out. But boy, what a week it's been. Last week, my title was Beware of Bull Traps. And you saw one on Monday, Tuesday, and Wednesday. Not much more to say except, I've learned through trading for what's now approaching probably 30 years, that if you sit on the sidelines for a day or two when the market starts to move, you still can make a lot of money. You don't have to go in at the first head fake, as it may be. So I've learned not to jump just because the market seems to be changing character. I wait and declare it. I also spend a lot of time on weekly charts, and weekly bars don't close until the end of the day Friday, not at Monday at 4 p.m. So this week, do trade war jitters drive markets below critical support? We really are at a place that I'd expect to bounce under normal times, but we'll talk more about the headwinds that say this may be the time that we roll over. This is for educational purposes only. Any and all recommendations, straight education, not investment advice. I'm a doctor, not a broker. I am truly independent. I pay for all the tools that I use, so nothing that I say here is promotional by any third party, and trading involves risk, and you are solely responsible for any decisions you make. I follow many different people. I've learned my own style. Many of the people and companies that I follow are here. I call my trading style be your own guru, which is learn from others, create your own, and get good at it. What I need on my desert isle besides high-speed internet, I need a real-time charting and trading platform. I have a number of indicators that I use for TradeStation and Thinkorswim. They help me to find stocks that I'm interested in, but it's really about the price and volume action. For analysis, I use HGSI, EdgeRater, and the Q tools for superior profit. I want to call out that I got a nice little email yesterday from Chris over at EdgeRater with a link to a new program called EdgeRater Pro 2020. He wants me to be a beta tester for. So coming soon will be a new version of EdgeRater Pro. Website for HGSI is here. Again, I don't get paid by HGSI for doing these. My email address is similar, but it's different. But what I want you to point out is that there's a free 30-day trial, and under investing strategies, whether you register or not, pay or not, are hundreds of videos like this from myself and Ron Brown. Well, I always go to this, and people may get bored with it. I know my son makes comments that I spend too much time in the PowerPoint. But the most important question for Monday through Friday is, where are the markets on this chart? Are we in the red circle, and this is the time that we go on and retest perhaps the June lows, maybe even the December, November lows? Or is this going to be like the last 10 times I cried wolf or cautioned wolf, didn't cry wolf, and the market went on to new highs in sort of that Darvish-Box phenomenon of up and down with a slight upward slant? I don't know. You don't know. I've got to be prepared for both. I know that the stocks that I talk about go up like rockets, but they fall like rocks. And you need to know not only where the market is, but what stage is a stock in before you buy it. Now, I changed my stance in the market. When we finally do get our flush in the market and go down and set a new base and build from there, I'm going to be all in when we break out, buying stocks, calls, selling puts, maybe cover calls. I doubt it in the early stages of a new bull put spreads. But we're not there. We are either in the middle where raising cash, smaller positions, and selling premium makes sense, which I've been doing now for the last month, or it's time to start looking at some positions that protect you to the downside. I'll talk a lot today about contra ETFs. I'll talk a little bit about shorting, probably very little about shorting, and I like to buy puts instead of selling short. The advantage of puts is my downside is limited to the premium, but the premiums get expensive in the setting of volatile markets. You can generate some cash to pay for those premiums by selling some bear call spreads. So let's look at the market end on Friday. Yeah, this is what is referred to commonly as a sea of red. We had some positive. We had gold, GDX and GLD, bonds, TLT, and then a couple based upon earnings such as CRM, Salesforce.com, and Intuit. But other than that, this was an ugly day in the market. Thursday wasn't so pretty either. Now let's just pause this and go into Thinkorswim. All right, we're now in Thinkorswim, and I wanted to show you a couple of things. I have a slide of this, but I think I could show it here better. This is the top is looking at the treasury rates, and the various durations are up at the top, everywhere from a 3-month to a 30-year. Notice how they've come very close together. A yield inversion, as I understand it, is when, if you think about buying a house, if you were to buy a 2-year mortgage, you know you pay lower interest rates than if you bought a 30-year mortgage. That's sort of common sense. Why would I want to commit my money to a low rate over 30 years if I was letting you borrow? A yield inversion occurs when the 30-year rate, or in this case, the 10-year rate, the 2-10 spread, is lower than the short-term rates. And that usually precedes, sometimes by as much as a year or more, a recession in the economy. So this is the S&P in magenta. And, if you just look at a line chart on the S&P, and you look at where we've come from 2009, we've done this a lot. 2010, 2011, 15 and 16, 18, little bit in 19. So we really haven't done anything here on the S&P that's unusual. Just maybe it feels different this time. But if you look at the blue thing here, notice how it's almost down to this pink line. This pink line is where the inversion occurs. If it gets below the pink line, that's when the inversion is. We are sitting like 0.01 above that pink line right now. So we're about to invert. Now, there was an intraday inversion. Some of the different yield spreads have inverted, but this is the one that I read that most people follow. Now, I also want to point something out, and I've been saying this for a year. I actually heard somebody say it on CNBC, and it actually made me feel good because I hadn't heard anybody else say it. If we look at when this yield curve falls, and we look at the S&P, the yield curve inverting is not the signal for the market to roll over. It's probably when they start cutting rates aggressively and the yield curve uninverts when the S&P falls over. Yield curve inverted here, it inverted here, and it's some period of time before the markets roll over. So yield curve inversions, everybody's talking about. I just thought I would look at it. Let's look at the markets in Thinkorswim. I look at a number of different platforms because I know that not everybody uses the same platform. I also spend a lot of time looking in the market because if you're really here today for me to tell you what great stocks to buy and how to make money, I would tell you that you need to come back in a few more weeks. So let's take a look at this. I'll show you how to make money, but it's not going to be buying stocks yet. E-minis. Anybody think it's inevitable that we come down and test the 200-day moving average in red? That is at 2803. We're at 2851. We dropped 70 points on Friday on the E-mini futures. Heck, we may visit that tonight. So I think it's inevitable. Notice that going back to 2018, actually 2011, I'm sorry, each time we came down to the 200, we went below it and then rapidly reversed. So that would be perhaps my expectation and my hope. Now, if you go back to 2015, no, excuse me, I have to do better on that. I got to get my years straight. And this is a daily chart. So this was all this year. This is December 2018. So you go back to 2018 in October, you can see we did not hold above the 200. In fact, we got right above it and failed each time. And you notice how good these little yellow arrows are? You all got those. They're free. They're called the person PPS single edit study PPS. If you go into your Thinkorswim add study, John Person's indicators, that's that thing right there, the PPS. It's a freebie in Thinkorswim. Very good at calling reversals in the market. So going back for the last year or so, the 200-day is held, except in the October to December timeframe. How about the NASDAQ futures? Same thing. Again, 72.62. We're at 74.90. It's 228 more points. We were down 221 on Friday. Not out of the realm. And again, the same thing, will the 200-day hold? That's what we're going to have to bank on. The Dow futures, well, they're there already. That's interesting, isn't it? We'll see if the Dow futures bounce or not. Now, they've been here several times of late, and each time they've undercut and rallied. And so we'll see. I mean, the bull might say, gee, Jeff, you've got higher lows here, so you're not really in a downtrend. Yeah. Notice the sell signal came in Friday. Now, the bad guy has been the Russell. This is it's actually Russell Future, a Russell ETF. And you notice that it's now living below the 200. And this is where my fear comes in. If we don't rapidly bounce back above, then what has been resistance? This isn't the right chart to look at that, but let's think about the E-mini, the NASDAQ, the Dow. What has been resistance, or support rather, becomes resistance. What has been support can become resistance. This 200-day moving average, we've tested it a couple of times and failed, so to the downside. So that worries me, and that's kind of the question mark. Do we bounce and go on to new highs, or do we break through that 200-day moving average, and that what was once support turns into resistance? Speaking of bouncing, look at the VIX. Now, back in December of 2018, the VIX got up to 27, and we are sitting at 1992. So certainly would not be surprised to see another run up in the VIX as we go and test prior the 200-day moving average and potentially some prior lows. And the dollar throughout this has actually started to weaken with the tariff wars that came in on Friday. If the dollar is weak, you know what's strong: gold, silver, and potentially even bonds. So that's on the daily charts, and I think that tells enough of a story. I can go back into my PowerPoint. Now, on the weekly charts, not much to say except we really are in a very nice uptrend, and we're pulling back to the yellow on the weekly, which is the 50-week moving average. We could bounce from there, but I do think that we've got more pain to come. The red here is the 200 weekly or the 1,000-day moving average. I certainly don't want to go there. So if I look at this and somebody goes, well, Jeff, what do you think our downside risk is? Well, I think the immediate scenario is to hit the 200-day and bounce, which would be the kind of where the 50 is. I think we have a June-ish low here where my arrow is, and we'll look at it more in HGSI. We've got a December low, and I think those are in play. I really don't think that we have a clear scenario to break out to higher highs, although we're just one tweet away from everything changing. What's driving the markets? I showed you the yield inversion. Well, let's look at the yield curves. Probably a great time to buy a house if you could actually get a mortgage or refinance, because we're at record 30-year rates. Here's a 30-year. Here's a 10-year. And you can see we're just dropping like a rock. Now, I went back to the turn of the century, and you can see we're at all-time lows on the 30-year, and we're kind of approaching the 16 lows before the market reversed on the 10-year, and we're approaching the 2012, and we never got this low in 2000. And, well, we got in the neighborhood in 2006, 2007, 2008. All right, what else we got for you? We showed you this. Small stocks leave the AD line. So on the yellow is the S&P 500. So ignore that here. But let's look at this fine white line. Notice on the 2000, it's falling hard, and it's kind of sideways on the 1000. So much of but not all the damage is in the smaller stocks. Now look at the NYSE, which is a pretty broad index. You can see it's fallen as well. Interesting thing, the bonds actually gave back a little bit on Friday with the market selling off, but the bonds have been very strong. And whether I look at the green, yellow, and blue, which are the diamonds, spiders, and Qs, I look at the transports or the Russell, everything is selling off in this market. Now, here's another interesting thing. We've had a big move from overbought to oversold, especially on the short-term ones. But looking at stocks above the 200, stocks above the 400-day or 40-day moving average, we are not at reversal areas. We could reverse, but we're certainly not at major reversal points. The T2121 is getting close. This is the quickest mover, but there could be several more days. Now, there's also no rule that says you have to reverse. And if we look at the 8-9 market as an example, we bounced, we went up for a day, came back down, so on and so forth several times. So we still have more damage that can come. The McClellan called this out. I could show you some S&P weekly versus momentum with bearish divergences as well. This is just the market's higher highs, lower highs on the oscillator and the summation index. That's pretty much off. It's already predicted. It's already worked out. Now it's time to start looking at the oscillator and see, are we getting to the point where we're oversold enough? At minus 55, the answer is no. You get me down to 200 or more on the minus 200 on the oscillator, and we're talking. We still have a ways to go down. That could happen in one day. The weekly, you could see the oscillator is a little bit below zero, and would expect 200 or more, minus 200 or more, to give us a signal. Buckets. On the left, you can see where we ended the week. 79% of stocks below the midline of their Bollinger Bands in the S&P 1500. You can see that only about 7% were below their Bollinger Bands. That gets to 20 to 30 before we reverse, so we are not there yet. We could reverse on news. Like, this is the most crazy tweet-driven market I've ever seen, but my signals say not counting on it. On the right, you can see the difference in the hashes of what it looked like on Thursday and Friday, and notice the big increase. And this is on my trading universe, which is all stocks 5 and 500,000. How many more went to the below the band on Friday compared to on Thursday? And the stocks that seem to be doing okay have pretty much disappeared. So rapid deterioration there. The Henneys, they're off the table now because they did their job. Remember, Hindenburg has predicted every major market pullback since the war. So a lot of them are false, but not when I see a stream of them. So here we are in May, June, we had a sell-off. We had another one here, strongly predicted by the Hindenburg omen. They won't be in play again until we go back to new highs. Market tone. We were starting to give us, here's your bull trap, starting to think we're turning around. And then Friday, we just had a massive down day shifting. These are kahunas to the downside and all the one-day change. Percent Bs all became bearish, but we haven't flipped the Woody indicator, which is a percent B times bandwidth. So they're neutral. One more bad day on Monday, they'll be red as well. Now the sector strength did deteriorate where you've got a bunch of red showing up, and the only green you might expect it to be in staples, which is not green, but real estate and utilities, defensive sectors. Now, other signs that this time may be different, and I mean different to the bad side. Canaries in the coal mine, the big stocks, they've been flirting with rolling over. I just get the feeling they're rolling over here. Everything turned red up at top. They had a mobile breakdown from a squeeze. My indicator fired. They had a pocket pivot to the downside. They had a Phoenix, which I'll come back to in a second, and they had a kahuna. Everything but the Phoenix is calculated on an artificial index of the Canaries. If that was they were all blues and greens, we'd be buy, 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 buy. Those are a strong sell signal. All of the stocks in the Canaries are in a sell. They all flip to a sell on Friday. 1, 2, 3, 4, 5. No, I guess 1 or 2 might still be a buy. No, they're all in a sell. 6 of them flipping to a sell on Friday. You can see 100% are in sells. That Phoenix is the follow-through date to the downside that Ian Woodward created, and that's really bothersome. 2 Phoenixes occurring not far from highs. All right, we're off highs, of course, but we're much closer to highs than we are to all-time lows. It is very ominous for this market. Now, I had a group of leaders that I chose in March of this year, and I've been commenting on these about how they've been going sideways to an upspin despite all the aberrations in the market. Well, they finally broke down, and I think this might be the most telling of all the charts that usually we put this together when markets are at tops. We watch it closely, and when yesterday's leaders roll over, it's usually a signal, or the most recent leaders roll over, it's a signal that it's time to get out of the market. It's rolling over hard. Know your news and your earnings. As it says in the lower right-hand corner, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. You too can get this pretty chart. Just go to in Twitter, search earnings whispers, and this pops up every day with some analysis about the individual stocks. And on the weekend, they show you everything. As I look through, there are still some big stocks that you may care about. For example, Momo, Vivo, Autodesk are all important to some of us. OKTA has been a big mover, as Five Below, a discount retailer, Chico's, where my mom likes to shop, Box, Ulta, that's a big one, Workday, Burlington, another big retailer, Jinko Software, Big Lots, Frontline. So there's a lot of things this week. So we're still in the heart of earnings. On the left-hand side, this comes from Econo Day. They power I used to download it from Bloomberg. But here's the source URL. Red is what you want to look out for, durable goods on Monday, petroleum on Wednesday, that's a weekly. Jobless claim on Thursday, GDP should be interesting. Personal income on Friday. You have a Fed head speaking on Wednesday, Mary Daly. A big thing to point out, this is, I think, the G7, now being referred to as the G6 plus one, as they isolate Trump, or Trump isolates himself, and anything could come out of there. I mean, with weakening economies throughout the world, rates below zero in many entities, it's always going to be interesting what the huffing and puffing says. So, markets sell off hard, down 2 to 3% Friday after escalation of trade war, despite dovish comments from, and I can't spell it, 1 in the morning, obviously, from Fed head Powell. Continued bantering between the president and the Fed head is not healthy for this market. Mostly from the president to the Fed head. The Fed head is a gentleman. Investors flocked to safe havens as the early week bull trap ended with a hard landing, and all S&P sectors ended up down, while gold, silver, the yen, and U.S. Treasuries rally in a flight to safety. The markets are sitting on major support. Continued trade war bantering over weekend may exacerbate with a sell-off Monday, although G7 comments could mitigate as Trump is to meet his Chinese counterparts. My top-down reviews reveals few places to hide outside the safe havens, gold, silver, and contra ETFs. I personally have lower positions and more cash than I've had at any time in the last 5 years. I have puts on a couple of my long-term winners. I'm in Amazon since the 400s, and Bank of America since the single digits. I don't want to sell them and create big capital gains. I'm planning on giving them to charities or something when I die, so I put puts on them. And that's a little long thinking. I probably won't last that long, but you can give stock to charity. You don't have to die first. So I put puts on it to protect the value. And it's kind of fun. Amazon comes down and takes some cash off without having to pay the capital gains on my big move. But I've got puts on Amazon and Bank of America. I bought some contra ETFs right now. I'm short SOXL, so I actually shorted the long because I figure I get more bang for the buck. I am also short SPXL. And both of those are multipliers of the semis and the spiders. Sometimes sitting idle is not a bad approach. Avoid over trading here. I said this in the beginning. When I was a little boy trader, every time the market looked like it was going to reverse, I had FOMO, something that my son exhibits today. And I found as I grew up that you get a chance to get in that's safer. You don't have to be the first in. You want to be in right, not first. All right, let's take a look at the markets. If you're here to find a shopping list of longs that are bullish growth stocks, come back in a couple weeks. We'll kill this one too. Do that later. So we've looked at that. All right, in TradeStation, I like to go in and just look at the major indices, applying some of my favorite indicators to them. And I do the same top-down review every week. Some weeks I spend a lot of time on stocks. This probably ain't going to be one of them. On the E-minis, and here's what I look at. All right, I've got 6 indicators that I'm going to pay attention to. Number one, just as I showed you in Thinkorswim, the little arrows, I have John Person's signals for TradeStation. Red on the daily, red on the weekly, still holding green on the monthly. Number 2, Alexander Elder paint bars, his impulse indicator. When it's red, I can be shorting or holding. I shouldn't be buying anything new. When it's green, I should be long or holding. I shouldn't be shorting. And when it's blue, I can do whatever I want. Red, red, and blue. So I've got double bearish so far, at least on the daily and the weekly. Where am I within the envelopes? I know that if I get way outside the envelopes, I usually reverse it a couple of bars. I'm still within the auto envelope from Elder. Number 4, do I have any evidence of divergence? These red dots that occur here at the top are suggestions of MACD divergence. I can get green dots on the bottom, which are a bullish signal. I don't see those. Number 5, is my weekly bongo red or green? That's a buy-sell indicator for me that I've been using in HGSI for a long time. That's red. And number 6, is the high jump at an extreme? An extreme would be less than 20 or more than 90, 93. We're not at an extreme. If we go back to the height of the market, which would have been over here, my high jump was 87. And then, all right, so this somewhere it was high. Here it was. And this is probably the closing high on the market, 97.58. And we would have talked about it that day that that's a dangerous sign of the markets being overstretched. All right, the Dow futures. Very quickly. Down, down, red, 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 within the envelopes, 61. Next, looks just like the E-minis, the NASDAQ futures. Down, down, within the envelope, no MACD, red, 64. And the Russell futures, same thing. I might go down and look at the dollar. Now that would be good because I've got a boatload of gold and silver positions right now. So a sell signal came in on Friday on gold. Still a longer term buy signal on the dollar. I mean, the sell signal on the dollar came in. Still a longer term buy signal, and it's nowhere dangerous on the high jump bar. Notice all these red dots here. Just because you see them doesn't mean it happens, but typically after several of them, the market rolls over. Here were the green dots when the dollar was too weak, perhaps, and that told us that we're likely to see a recovery. And if I look at gold, you'll see a big move here. Notice the red dots, so gold is clearly at risk. Now, all that's telling you is that underneath you're seeing some divergences or potential MACD divergence, and that to be wary. And I don't usually do a lot of drawing in here, so I'm far from an expert in drawing, but let's see if I can't get a trend line and show you what I'm talking about. So here's a high, and here's the next high. And notice how we have lower highs on the MACD and higher highs on price. That's just telling you that that's formed. It's kind of a nice how it does that for you. Now let's jump into HGSI. In HGSI, I always do things the same way every time. I go into my market analysis. I go into Major Markets Plus. I open up 25 things. I hit this. They'll open up right next door. Please. There you go. And I put my top-down view on them. I notice that as long as I'm sorting by raw combo, the best come to the top. Gold miners, gold and silver, bonds, volatility. How many are you going to make? How much money are you going to make long the stock market in growth stocks, blue chips, etc., when the best performers are commodity related and the small caps, biotech, transports are down in the toilet? Yeah, it's hard to make money like that. So let's just quickly look. Again, why does he spend so much time on the market? Because I don't care how good of a picker you are. If this market continues current direction and you start picking stocks because you think they look great charts and you're going long growth stocks and blue chippers, you're going to lose money. I guarantee it. Just like the guy in Men's Warehouse. It's very difficult to find out of the 8,000 stocks, the 50 to 100 that are going to do well despite the market selling off. Obviously, there's some stocks that don't correlate well with overall market. So let's take a look at my index view. So what do I see here? Here's the S&P. Now, I guess I could say, just make me look that we're still in my box. So as long as we're in the box, there's nothing to say. And right now we're in the middle of the box, and maybe we go further down, maybe we bounce. I guess that's the bullish. I'm not real bullish right now. I'm not real bullish because my daily bongo, my sell indicator fired, the weekly bongo, we're certainly not near the low jump. We're not oversold. Here's the Hindenburgs. This is the bingo, which was a baby out with a bathwater day. We've now had 3 phoenixes and only 1 eureka, which is the opposite of a phoenix, since August 1st. 3 phoenixes in a row. I don't see them here. Do you? They don't occur very often. So I start every analysis with where's my high, low road scenario. Hold on one second. Let me just put one thing here. I mean, we could certainly argue that we're off the trend lines and this is a normal place to bounce. I'd love it. I'd love it. I'm okay with that. That's just not what I'm feeling. So if I start thinking about what my scenarios are, sure. A high road is we do this. If you really believe that's what's going to occur, I'd like to sell you some property. The low road is we do this. I don't think either of those occur. I think what occurs is either we pull back and we bounce a few times and then break down, but now we're getting towards November, December, or we do that a few times and instead of breaking down, we go back up. I think that's likely to occur. I do think we're going to retest the bottom of the box. Certainly, we're going to retest the 200-day moving average. And I, for one, do not feel like Monday is a time to be a hero, pending crazy news-driven changes in the futures markets. That is the S&P 500. If I look at the Dow Jones Industrial, and let's point out Dow Jones Industrials had a new high in the market on April 24th when it rolled over. Okay. Um, head and shoulders, 1, 2, 3, neckline breaking down, eureka's on the markets, not on the individual. Everything looks pretty ominous here. The question is it getting so ominous it's due a bounce? And you look at the Dow, and we're kind of traded down and bounced off of what was the June lows. Look at that. I didn't even see that because the futures and the cash markets are a little bit different. Isn't that interesting? So now, does that mean we're going higher? So that may be even better than that trend line. I really wish we were going higher. I'm not a perma bear. In fact, I'm a perma bull. And this could be another bullish signal if the news allows us that we're going to bounce. I still think the risk is in retesting down here from December, but we'll see. All right. So that is the Dow. Let's look at, this is the transports rather. So the transports high was April 24th. The Dow, and I want to do that for a reason, Dow Jones Industrials high was in July. We took out the April highs. We did not confirm the highs on the Dow Industrials with the transports. That's a bearish signal. Transports may bounce here. The Dow may bounce here. It's sitting on support. But according to Dow theory, we did not confirm the new highs, which is a bearish signal. Looking quickly at the NASDAQ composite, certainly has some room to fall like the S&P. We already talked about the dollar being uber strong. Maybe you don't play futures, you play ETFs, and you can see the dollar sold off on Friday, as we talked about. That's a low close doji as well from John Person. And if you look at volatility, spiking here, but certainly not to where it could go. Now, this is not the future. This is the VIX.X. And you could see it could go up as high as 36 or beyond. And it's only down around 20, so it has a ways to go. And then I can look at gold. If you want to see where the love is, breaking out, not all-time highs, because it was a lot higher in the past, but recent highs. And if you're a gold bug, you've got to love this run. Now notice some things that I talk about on the weekly chart. I had my buy indicator came here, which was the same indicator that we crossed over the magic line. And that's kind of why I like that magic line. It works over and over and over again. Something that I'll be teaching in November. A few comments to follow about that perhaps. Gold miners also were strong on Friday, flight to safety. And then silver hit. What's not been strong has been oil. All right, so hopefully I've depressed you if you're long the market. This is not what you want to see. Failing at resistance multiple times probably comes back down and retesting these lows. If you're long the market and you're excited by the market, God bless you. I'm not. If I go to industry groups, you can see I've got 174 industry groups. How many of these are short-term bullish? One. When's the last time I showed you one? In a long time. Long time. How many of these are short-term bearish? 48. That means they turned bearish within the last couple of days. How many of them are long-term bullish? 2. How many of them are longer-term bearish? 84. So I ask you again, considering these numbers, what's the likelihood of you finding some great stocks to go long on Monday morning, barring major reversals in the news flow and the futures? I think you put your pen down. Let's just look at some things, because you're not. I really don't want you to be going long unless you're willing to pay the commodities that I'm going to show you or contra ETFs. So I right-click on precious metals, and I'm going to Well, yeah, this is fine. Let's just look at scorecard view for this, which takes in fundamentals and technicals. I got 24 that make it to my list. These are all stocks that are in the leaders. You can see the industry group was up 4.30. Now, I'll show you some other things that I do. And all the things that I play that are mine indicators, they're not secrets. I'm trying to put a brand on them with somebody that's in the marketplace, and they've agreed. It's just taking time to do the work, but we'll come out with an add-on, and my signals will be enhanced to actually be their signals. But it's really helped me in my top-down review. You might look at my intraday that I did a couple months ago. But let's switch this to my stock view. Let's drop down this box. So a couple things I want to point out. This is Kirkland Gold. June of 18 is when I gave Tandem. Nope, June of 17. It was June of 17. March of 17? I'm trying to think when I gave it. I gave Tandem, and the other stock I was going to do that day was Kirkland Gold. It doesn't go back far enough. And Kirkland Gold was like $10 a share, and it had already had a big move. Kirkland Gold is one of the best performers in the market. It's gone from 20 to 50 in less than a year. That's the weekly. On the daily, steady uptrend. It's coming out of a squeeze, had a mobile breakout, and a kahuna. Notice the Eureka prints, because the Phoenix prints, it's on the market. Now, what does it tell me down here? It tells me that within its industry group, precious mining's 92.6% of the stocks are in a current daily buy. 6 went to a buy Friday, 1 went to a sell. No bullish or bearish doji reversals. Okay, so that's interesting. So would I buy it here? Absolutely, yes. I've got a mobile breakup from a squeeze, maybe set my buy above the PSAR dot, have a kahuna. That looks great. Petroleum Resources, another one of these stocks that did absolutely nothing. Then here we go. June of this year, what happens? We had a kahuna, mobile breakout from a squeeze, a breakout from the moving averages. I think this met the power of 3 conditions of Fred Richards. We go back here at the same time, we cross above the magic line, 524, and off and running, driven by huge earnings. I think this thing still looks good. It's buyable here. Great earnings per share growth. Silver Standard Resources, I didn't know this one before. Maybe they changed their name. Pullback. We got my indicator, a pocket pivot, a kahuna, mobile breakout from a squeeze. You can pick your poison here. There's a lot. First Majestic Silver. All of these look good. Franklin, Nevada breaking out to new recent highs, time highs, Newmont Mining. So pick poison. If you look at my buy watch list in a few minutes, you're going to see it's heavy related to gold and silver. Where I get challenged is using my scanning to find good stocks to short. I'm not sure I've got that right yet, but I did look at stocks to short. So let's go back here. Let's look at 2-day down. All right. So let's just look at some of these integrated oils. I mean, when I look at this, I see stocks that have sold off hard, and I'm not sure I would go and start shorting a stock that's down 25% already. Probably goes down. Chevron, a little bit more interesting. It could have a long way to fall. It's got negative earnings per share growth, does pay a 4% dividend. Petrobras, So this is an index that's pretty beat up already. All right, what else we got? Automobiles. China talking about tariffs up to about 50% on Tesla. That'll be on somebody's list to sell short on Monday. Here's a stock that is breaking down below the 50. The bingo's the baby out with the bathwater. It's got a bearish doji reversal. There's your doji bar closing below. 92% of the group stocks in this group have a sell signal. 8 new sells on Friday. Ford Motor Company is just a cheap stock. I like to short more expensive stocks or buy puts. GM. So let me just say that there are a lot of ugly stocks out there. I'll show you some of the ones, some of the charts that interested me, perhaps on the shorting side. As I said, today is not a day of talking about what to buy, but I am going to show you some things I'm looking at. So these are some stocks that I'm looking at as potential shorts. Now, I don't like to short new highs, okay? So I've got a breakdown below this moving average. Why would this make my list? Negative earnings per share growth. Defense may get hurt if the Dems come in. I had a bearish doji reversal here on the weekly on a stock that's rolling over. Cummings, it's already down a lot, but if the automobile and the transports continue to have the issues with China, the stock has a long ways to run. It's got negative earnings per share growth coming. Aon, perhaps a better picture, broke below the 50, has a new sell signal, kahuna to the downside, pocket pivot. I'd rather see them breaking below the magic line, but sometimes they fall a lot then. Willis Towers is another one that generated my interest. Rolling over here like faucet, new sell signals, expensive stock, mobile breakdown from a squeeze. Roper, failing at the 50. This is the chandelier stop. That would be my stop. My target would be to come down to the 200. Copart, another one breaking down at the 50. Target's probably going to be around this level here, which will be right where the 200-day moving average is when it gets there. Cintas, breaking down. This is a chandelier stop, so a break below that stop would be the trigger. I'd probably look for to short it when it breaks down below the 50 and doesn't bounce. Tempur-Pedic breaking down below the 50. So there are lots of ugly stocks. Now, the funny thing is, in a bullish market, I might be looking to buy this, but it would be a green bar and a buy signal on that pullback, not a red bar. Now, retracements in a downtrend are great. Probably too early to see a lot of retracements in downtrends. Here's a retracement in downtrend stocks. I like buying this when it moves up during the day, or shorting it and let it come back down to me. So lots of things to short. Let's talk about buying, because I know that's what people enjoy more, is buying than selling. Although in a market like this, you want to be selling, not buying. So I did have a bunch. So let's talk about what I had, and I think you're going to see a theme right away. First of all, I got less of a bunch than I've had in other weeks. Let's look at my industries. First, I have a lot of white. We'll talk about those in a second. I had one bank, and it's an international bank, and the only reason why it's here is so I watch it. And the reason why I liked it is because it's pulled back to the 200, a place where I'd expect it to bounce, and it bounced and had a kahuna on Friday. It also had not quite a hammer, but it had a big bottoming tail on the weekly. I'm not buying it. I'm going to watch it. The only reason I'm interested in that bank is because of that pattern. Only one biotech made my list, and that's Canaries. And It's a biosimilar company that actually turned a profit, which was amazing. So it's, new profits in a biotech, growing revenues. I found that to be interesting, great earnings per share growth, but I'm not sure I'd be buying anything long except for commodities. A lot of precious metal stocks, and then some REITs who should benefit from the big dividends, like Omega Healthcare, talked about numerous times on my web videos, breaking out here, 6.5% dividend. Now, I'm a cancer doctor by training, so I can't in my conscious buy a tobacco stock. But if I did want to buy a tobacco stock, I'd be buying Vector Group. Bullish doji reversal on the weekly. There's your doji, and here you are closing above it 3 weeks in a row. That's very bullish. My magic line crossed over. We're way down from the highs of 20. Everything is green. Oh, by the way, it pays a 12.8% dividend yield. Now, I haven't done a lot of research on it because I can't buy it ethically. But I'll make sure that they can keep up and see what their history is on that yield. And then Urban Outfitters, there's been stir retail over the last week or two. And Urban Outfitters, the reason why I liked it, because if we took away the 1 day, you had a stock that on earnings broke out, had multiple kahunas, pocket pivots, a mobile breakout, who makes money, who's starting to perhaps turn around, under accumulation, heading up towards the zero line on the weekly. The weekly signal, bullish doji reversal. I think it looks great, but Friday obviously took down everybody that looked good, so I wait and see what it does. We'll talk about what's at the top of the list. So if you don't know what an ETF or an ETN is, you need to learn. I look at them as kind of like mutual funds, kind of like a mutual fund, and that a third party is curating the list, and the list is designed to either mimic or perform as it would as a basket of stocks of a specific type might. Now, the benefits of ETFs and ETNs are that you can often short them or go long. You can find whatever industry sector you want, look at 1x, 2x, or 3x. That if you're in many IRAs where you're not allowed to short the market or short a stock, you could buy a contra ETF, which you buy to go up when the market itself is going down. What's bad with these ETFs is that there are some, and ETNs, some fees for managing them, usually very low. But if you have an FAS, which is a financials 3x up, and an FAZ, financial 3x down, they should always, if you bought one of each, then theoretically they would be equal but opposite. Your money should be the same after a period of time. No reason why you want to do that. But actually, your equity curve will drift down because of the expenses. So they're more of a trading vehicle than a long-term hold, although I have bought LABU periods of time under the long term because it reduces some of the news risk on individual biotechs. Here is JNUG, Junior Gold Miners. Looks just like the gold miners pull back to support. Kahuna, my signal fired, Mobo breakout. Weekly crossed over the magic line in June. This is the time to have gotten interested in it. 3 kahunas in a row is always a very happy signal for me. But I think this is something you could be buying. You can also buy options on these. Here's a 3X bear fund. This one goes up when the S&P goes down. So you're buying it off the bottom. And this is one that I have a position in today. Actually, I got the long version short. And the reason being is the long is in the $50, so 10% move there is worth more dollars than a 10% move here. But if this was a stock, it's basing, it had my indicator, a pocket pivot, a kahuna, a mobile breakout from a squeeze. SPXS goes up when the S&P goes down. FAZ, same exact pattern. It goes up when financials go down. Look at the demand. When the demand is this high, the options start to get priced expensive, so you might want to buy shares. The Qs, buy signal, pocket pivot, kahuna, mobile breakout. Let it get above the PSAR dot. This goes up when technology and the NASDAQ 100 goes down. TZA, a 3X variant of the Russell. You can buy 1X, 2X. I like to buy 3X. Mobile breakout, my signal, pocket pivot, kahuna, breaking above the 200. Move above those PSAR dots. It's time to buy. And you can see the magic line was crossed as well. How about more gold? This one actually owns the gold itself, not, let's see what it says here. It doesn't have the story. Okay. Spot Physical Gold Trust. Pull back to support. Buy. Look at the volume. Is it getting expensive? Sure, it's getting expensive. It goes up with the price of gold. Look at that price and compare it to the gold ETFs, the 1Xs. It's very similar, just with a decimal point difference. How about you want more for your money on the Qs? I think this is Ultra 2. I can't remember if this is a 2X. I think it's 2X. But again, it goes up when the NASDAQ 100 goes down. Another one on the S&P. Another on the Qs. There's a whole bunch of ETFs, and then you could even buy ETFs on the VIX that go up when the VIX goes up. Now, in HGSI, if you go into the top part, which in my seminars I always call like the filing cabinet, you'll see component lists. In the component list, you'll see ETF components. And you could look for families like the Deteriorates families. But you have a bunch of ETFs that you can see what's in them. So you could look at the components. Here's the Pro Shares. So the Ultra S&P, they have the same, should have the, 502. Google's in a couple of times. You have the ETF is made up of the underlying index. Just about done here. For those who are wondering when I'm going to shut up. If you go in here, you can start to see a bunch of the ETF families. The 3Xs are called Deteriorates. And you can find them for many different industry, robots, pharma, industrials, emerging, Japan, the major. So you can buy 1X, 2X, or 3X on the indexes. You can be long or short expiration production. So I typically will hedge my bets during markets like this and try and reduce the downside risk by buying some of those contra ETFs. A contra ETF, just for further review, is an ETF that goes up when the specific market goes down. I just want to end today by quickly looking at the Canaries. I know that these are very widely held, and I get a lot of questions sometimes via email of what I think about these stocks. So let's look at them very quickly, and then we'll say goodbye. These used to be your father's leaders. I'm not sure they're necessarily going to be leaders in the next run of the market. And that's something to keep in mind. This market will turn around at some point. This market will run This market someday, maybe we'll still be alive. We'll set new highs. I certainly hope I'll still be alive. But the leaders in the new highs may not be the stocks that we grew up with. So this is Tesla. I don't know how I could be long Tesla here. I certainly wouldn't want to be long here. It's giving me another shorting opportunity. But what I want to point out on Tesla, one of my scans in EdgeRater is retracements in a downtrend. The retracements in a downtrend mean I come up, here's the chandelier, and I drop. Over and over again, a retracement in a downtrend is giving me opportunities to short. Okay, this one surprised and broke up, and now it's going down again. So these are opportunities to short. You don't want to be long the red arrow. You want to be short the black arrow. Which one is longer? Of course, the black arrow is longer. That's where you make your money. This time, you got screwed around with by the market. So I look at this and I see a broken stock. I would want no part of it. I might be shorting it here. I think the 50% tariffs announced by China are going to be a death knell short term for Tesla. Although we all know that those tariffs don't necessarily ever happen. Alphabet, this made it to my shorting list. Why? We failed here, sitting on the 50. We've got my indicator short. We have a Taka pivot. We have a MOBO breakout. Sitting on the 50, I'd like to see it break down. And frankly, I might not short it until it breaks above the down below 200 because that's a natural bounce position as well. Would I be long Google here? Alphabet? No. Amazon, this pains me to say this one too. Is Amazon a long or a short here? My answer is maybe. Why would I say that? The reason why I got puts, I got a lot of puts, is because I just feel this thing breaking down. The government scrutiny, the European taxation they want to put on it, the too big in the marketplace tells me it's going lower. And boy, it's had a run. So even coming down and testing your March lows would still be a big move. But on the other hand, if I want to be bullish, I'd say, hey, you're sitting right on the 200-day moving average. You bounced from here before, it was resistance on the way up. We're going up. I think Amazon can go either way. But I have to let it declare itself before I would change my stance. I have a big long position. It's matched by a big put position. And I'm going to stay that way until it declares itself. Because the nice thing is, if it goes up, I make money on my stock, I lose money on my puts. If it goes down, I lose money on my stock, I make money on my puts, and I'm neutral. And then I have plenty of time to make a decision what I'm going to do. Now, some people would laugh at me and say, but Jeff, you're just paying premium to stay neutral. Why don't you sell it? The reason I don't sell it is because I got $1,400 profit per share. I don't want to pay the tax burden right now. And again, as I mentioned before, some of these I'll never sell. And they either go on, I give as gifts to charity because you get the full value without paying the tax burden. Of course, Elizabeth may change that. Apple. Pull back to the 50. Is this a time that's going to go up? Or is this thing going to break down with the stuff going on in China? My bet is it breaks down, but I wouldn't short it here because it's sitting on the 50. But a breakdown below the 50, and clearly with the Chinese issues, it's probably going lower. Baidu had great earnings. It didn't matter. It ran up into the 50. This is a retracement and a downtrend. I wouldn't be long Baidu there. Bookings, probably the best of the bunch, and it's kind of a messy chart. It's got 50-day and the 200-day as support. It's above the magic line. I probably would not be buying, but I wouldn't necessarily have to dump my bookings. Facebook, here's my target, the 200 is about 170. Maybe it doesn't have enough of a drop. Notice it did drop below the magic line here. I wouldn't be long Facebook. Netflix. Nope, wouldn't be long Netflix either. Someday it's going to bounce. So I just looked at the big names in the stock market. You all ready to go buy them? I'm not. So I started this by saying last week, be wary of bull traps. You know, you can get bear traps too. Maybe I'm too bearish here. But I would not be jumping in long in this market except for contra ETFs until the market stops going down. It would be nice to start basing, have the news flow ease off, and then start a new uptrend. I don't see that happening, so I'm going to finish by saying be careful, tough market, raise cash, small positions. If you got to go long, stick your little toe in the water. And if it doesn't get bitten off by the sharks of Wall Street, you can make it bigger in a few days. Goodbye, everybody. Oh, I'm traveling the next couple of weeks, so perhaps I may not be doing these. Depends on the internet in my hotel. And the other thing is I'll be announcing a November speaking engagement in Vegas shortly. Goodbye.